Welcome to the Live Explore podcast. If you like what you hear, please hit like and subscribe.
Welcome back. I'm here with Blayney White, the originating branch manager for CrossCountry Mortgage here in Petaluma.
Yeah.
I've known Blayney for quite a while. We go back to the days of serving on the Sausalito Rotary Club.
Yes, we do.
And you're here to talk about construction loans, and we're going to talk about the for-profit construction loan.
Okie doke.
I'm Alan Maciel. This is Live Better, Explore More podcast. Welcome, Blayney.
Thank you, Alan. It's so great to be here with you.
How long have you been in lending?
Well, I'm going to date myself, but the truth is 22 years.
That's a while.
I know.
Okay, we're talking about construction loans. Tell us what types there are.
Okay, I will. You know, I wanted to preface this whole thing by saying last quarter, end of fourth quarter last year, I sat down and I took a look at what the future markets were going to need just based on how activity went last year, and I put together a suite of products for builders because I think 2023 and 2024 are hot for construction, rehabilitation, and so we needed loans for that. Today we're going to talk about building for profit.
Okay, so let's go over that. So there are different types of for-profit construction loans for profit. Can you tell us about them?
Sure. So definition of construction for profit is really for professionals. These are the people who have general contracting licenses, they're carrying insurance. It might be a realtor that fixes and flips and works in conjunction with a builder. So the intention of this work is to then put the property on the market and sell it once they're done with the work.
Okay, so you got these different types, like you have a fix and flip, you have a fix to rent, you have new construction, and then you have bridge lending. So let's start with fix and flip.
All right. So fix and flip is really intended for properties that need to be rehabilitated and are going to come back on the market. Typical time frame for a fix and flip is 13 months or less. And the way that those loans work is that they're going to put down 30% down payment on the purchase, and they're going to finance 100% of the rehabilitation budget. And the value is established based on the after repair value. So that's a fix and flip. Again, general contractors or professional real estate investors will know what fix and flip means, but that's really what it's intended for.
Is there a limit, like on the fix part? When you look at the property, right? There's some properties you look at and you go, that looks more like a scrape, right? And then there's some that you go, well, it needs to be fixed, but it's not horrible.
Yeah. So fix and flip is usually going to cap out at $3 million or less loan amount, whereas a scrape off, I've done loans up to $10 million for a scrape off, depending on what's going on with the property. So it's just a very different lending category in terms of, it's not, I hate the expression lipstick on a pig. It's much better than that, but it's really, you might take that place down to the studs in certain areas and fix up, rehabilitate other parts of the property.
Okay.
And not take it down to the studs.
Okay. And now fix to rent.
Fix to rent is for real estate professionals, whether you're a builder and you want to build your own portfolio of rental properties, or a real estate professional that's what they do. They buy properties, they fix them up, and they rent them out, and they keep them for the long haul. So think BRRRR. That's basically it's build, rehabilitate, rent, refinance, and repeat. So that product is scalable. It allows the borrower to take that loan and then put it on a new parcel without starting over with a brand new loan application. And it's really intended to scale and build a real estate portfolio efficiently and actually quickly, because you're not starting over with the lending process.
Okay, new construction, is that pretty much straightforward, or is there a catch to that?
New construction falls into a couple different categories. It might be a spec home general contractor that buys one piece of land, and either there's something there that needs to be scraped off or starting from scratch. Or it could mean a builder that wants to build a series of homes in a small community. The general contractor might actually start with the like the showroom home,
Okay.
and then sell the next lot, and that new construction loan could be scalable in that way as well. Or it could be as simple as acquire a lot, fix up the spec home, build it from scratch, and sell it, and then the loan goes away. Or it could be like a series of homes.
Okay, so in your example on new construction, I bought this land and I could put 20 houses on it, right? So is there a limit loan-wise as to, how much I can build? In other words, if 20 homes is too much because it exceeds, the $10 million or $20 million, what is the threshold, or is there a threshold?
I've seen that. That's a great question, Alan. I've seen that used in a couple of different ways because it's scalable. Typically, we're going to do 85% of the after repair value. So that kind of builder where they're building like a small community of 10 homes on one parcel, that's called a blanket loan. And so that builder can use the new construction financing as a blanket loan, and they can build the first house and start the foundation pouring on the second house so that they can sell it. And they may have everything all cordoned off with their story poles on the third piece of property that they plan to sell. So you may have a couple of different phased houses in building production, but as you peel off finished houses to sell, then you reapply that loan to the next section that you're going to build.
Okay, perfect. Bridge lending.
Bridge lending. Bridge lending is one of my favorites because it's really helpful to allow a residential, how would I put it? So they would have either a series of residential properties that they want to secure equity against, or they may have a commercial property that they want to secure the equity against, and they want to roll that equity forward to secure the purchase of another property. So the easiest way to think about it is like the Golden Gate Bridge. So you've got one foot of the bridge in San Francisco, you've got the other foot of the bridge in Marin. That particular investor, say they have a commercial property in San Francisco and it's got $2 million in equity in it, and they want to roll that equity forward as the down payment for the purchase on the next property, then that loan secures both properties and they share the equity until you're finished with the rehabilitation or general construction on the property in Marin.
Okay. And then once you do that, so, I've bought the property in Marin, right? And I rehabbed it, right? And then I can separate the loans on the properties?
Yep, you sure can. So what we would do then is we would probably with the sale, say that the idea is to sell San Francisco when they're done with the rehabilitation of Marin. The sale of San Francisco would pay off part of the bridge. So you'd get halfway across the Golden Gate Bridge, and the sale proceeds would pay off about half of that bridge loan, and then we would refinance the Marin property and it would pay off the other half of the bridge loan with permanent financing.
Okay.
Yep.
You talked about, a builder, and then you talked about somebody else, maybe a savvy person in real estate. These aren't, you have to have both these people, or can you have just one of them? Is it the builder can go by himself? Or if I'm a savvy real estate person, can I go get these loans and, find some people to build it?
Great question, Alan. The answer is the builder can go by themselves because they're licensed contractors and they know how to build to code, and they usually have architects they're working with, but needless to say, they've got the insurance, the experience, the subcontractor team. They can go on their own if they want to. If you're a real estate professional and you're savvy, you still need a general contractor / builder to do the other piece of the work. So you couldn't just hop in. If you are a real estate professional or you are an individual that owns a lot of real estate, you couldn't get the loan by yourself because you don't have the builder's experience.
Okay, and is there a list of builders, or is it any builder could potentially be, the builder?
Okay, so list of builders. Typically really qualified builders belong to their building associations for their counties. So a good example of that would be Marin Association of Builders.
Okay.
Yeah.
And so I could go there, find a builder if I don't know somebody locally. And then what requirements on the builder?
Well, the builder really needs to be an active and successful builder. We don't just want someone who just got their contractor's license last week jump in. They're looking for builders that have a fairly substantial resume for the last 36 months. It doesn't have to be super abundant because it's tiered pricing depending on experience, but you need to have some experience to get these loans.
And then on the loan, if I'm the savvy real estate person, right, and I have the builder, are we both on the loan, or is it just me on the loan? How does that work?
So typically the owner or the prospective buyer, there's going to be a financial person who secures the loan, and then the builder comes in with their construction experience. We could do joint ventures between the two of you, or you could secure it by yourself. It just depends on how you intend to work with your builder. Most builders don't want to be on the loan, though.
Can't imagine why.
I can't imagine why.
All right. And then, so if I want to get a hold of you, how do I get a hold of you if I have questions about these loans?
Well, you can Google me. It's Blayney White. My website is blaineywhite.com, and all of the contact information is there, but my mobile number is the best, and feel free to give me a call. I'm at 415-509-7788.
Perfect. Any questions I haven't asked you that you think we should talk about or you want to elaborate on?
You know what? I would say the only thing I really want to elaborate on is that most of the terms are either 13 months, 19 months, or 24 months for the loan product itself. And I also wanted to elaborate on the fact that you really do need to engage with me because it's not obvious how to calculate what the loan to value and after repair value is. So you may be looking at a property and think it doesn't work, but when you talk to me, I might be able to make it work for you. So definitely reach out and let me work the numbers for you to see if we can put the deal together.
And the loan to value and all that, is there a number right now you could say, hey, it's 70% loan to value, it's 80%?
Yeah, so typically the 70% loan to value is of the current value of the property, and then we're going to also finance with it the 100% of the rehabilitation budget. So if that's another, say, $1 million, that loan is one loan, and then the rehabilitation budget is distributed in a phased milestone project process.
Okay.
Yeah.
That's good. I mean, is there anything else that I might have missed that I should have asked?
No, I think that more people can apply and qualify for these loans than they're aware of, and it's worth a phone call to find out. So give me a call. Let's see what we can do to make something happen for you.
Tell us your number again.
415-509-7788.
Great. Thanks, Blayney.
Thanks, Alan.
Welcome to the Live Explore podcast. If you like what you hear, please hit like and subscribe.